euro to US dollar is currently holding its ground around 1.1150 after a solid bounce off 1.1100. Despite Germany's IFO survey coming in below expectations, the pair continues to push higher, buoyed by a generally positive market sentiment and a weakening US dollar. Traders are keenly watching for Fedspeak, as any hints from the Fed could significantly influence market dynamics. The focus is also on upcoming US sentiment data, which could provide further clarity on the economic outlook. With the current momentum, it's crucial to stay alert for any shifts that could impact this upward trajectory. The interplay between these factors will be key for traders looking to capitalize on potential moves in the euro to US dollar pair. As we analyze the euro to US dollar pair, it's crucial to note that any subsequent move up is likely to face resistance in the 1.1165 to 1.1170 supply zone. This area has historically acted as a barrier, and traders should be cautious. Beyond that, we have the year-to-date peak around the 1.1200 mark, which was reached in August. A decisive break above this level could serve as a fresh trigger for bullish traders, potentially igniting further upward momentum. Interestingly, while the oscillators on the daily chart have been losing some traction, they still maintain a mild positive bias. This suggests that the upward trajectory we've witnessed over the past 3 months could continue, provided we navigate these key resistance levels effectively. Keeping a close eye on these technical indicators will be essential for making informed trading decisions in the current market landscape. As we analyze the current state of the euro to US dollar pair, it's clear that the 1.1100 round figure is acting as a crucial support level, shielding the immediate downside. If we see a breach of the overnight swing low around 1.1085 to 1.1080, we could witness some follow-through selling. This might lead us to test the 50-day simple moving average, currently hovering near the 1.1020 zone. Should the price break below this level, the psychological barrier at 1.1000 comes into play. A decisive break here would not only signal that the euro to US dollar has likely topped out but could also open the floodgates for deeper losses. Traders should keep a close eye on these levels, as they will be pivotal in determining the next move in this currency pair. The recent corrective fall in the euro to US dollar pair could potentially drag spot prices down to the 1.0950 to 1.0940 region. Today, we see the pair edging higher, momentarily halting the previous day's decline triggered by disappointing Eurozone data. The S&P Global PMI Flash Composite revealed a contraction in business activity for the first time in 7 months, dropping to 48.9 in September from 51.0. This contraction indicates a significant slowdown, raising concerns about the Eurozone's economic health. As Forex traders, we need to closely monitor these developments. If the bearish sentiment continues, we might see further pressure on the euro, making those lower levels more likely. It's crucial to stay alert and adjust our strategies accordingly. The recent survey highlights a concerning trend. Germany and France, the backbone of the Eurozone, are primarily driving the economic slump. This downturn has significant implications, particularly as it intensifies speculation around a potential 25 basis point cut at the European Central Bank's upcoming meeting. The market's reaction has been swift, with the euro experiencing its most substantial drop against the US dollar in over 3 months. This scenario raises critical questions about the resilience of the currency union and the effectiveness of ECB policies in stabilizing the euro. As we analyze these developments, it becomes clear that the interplay between these two economies will be pivotal in shaping the Eurozone's economic landscape moving forward. In September, the US Composite PMI indicated that business activity remained steady, coming in at 54.4, a slight dip from August's 54.6. This stability is noteworthy, especially as the report highlighted a significant rise in average prices charged for goods and services, the fastest increase we've seen in 6 months. This uptick suggests a potential acceleration in inflation, which could have broader implications for monetary policy. As a result, we saw a modest boost in the greenback, contributing to the decline of the euro to US dollar pair. It's a clear signal that market dynamics are shifting, and analysts should keep a close eye on these trends as they unfold. Expectations for more aggressive policy easing by the Federal Reserve are significantly influencing the currency markets. The prevailing sentiment suggests that the Fed may implement another oversized rate cut at the upcoming November FOMC meeting, as indicated by the CME Group's FedWatch tool. This anticipation is effectively capping any substantial appreciation of the USD, which in turn is providing the euro to US dollar pair with an opportunity to regain some positive traction. As financial analysts, we must closely monitor these developments. The interplay between interest rate expectations and currency valuations is critical. A dovish Fed could lead to a weaker dollar, enhancing the attractiveness of the euro. This dynamic not only affects trading strategies but also has broader implications for global economic stability. Understanding these nuances will be essential as we navigate the evolving landscape of monetary policy and its impact on foreign exchange markets. The Fed's anticipated move to lower borrowing costs by 125 basis points in 2024 is gaining traction, especially after recent comments from key FOMC members. Neel Kashkari, the Minneapolis Fed president, highlighted a critical shift in the economic landscape. The focus is no longer solely on combating inflation. Instead, there's growing concern about a potential weakening in the labor market. This pivot suggests that the Fed is prioritizing economic stability over inflation control. For investors and traders, this could mean a more favorable environment for borrowing and spending, potentially stimulating growth. As we navigate these changes, it's essential to reassess our strategies in light of these evolving monetary policies. The implications for market dynamics could be significant, so staying informed is crucial. Recent statements from key Federal Reserve officials highlight a critical juncture in our economic landscape. Atlanta Fed President Raphael Bostic emphasizes that current data convincingly indicates the U.S. is on a sustainable path to price stability. However, he also warns of increasing risks to the labor market, a duality that cannot be overlooked. Meanwhile, Chicago Fed President Austin Goolsbee raises an important point about the labor market's volatility, noting that deterioration can occur rapidly. He argues that maintaining high interest rates may not be prudent if the goal is to stabilize the economy. This juxtaposition of price stability and labor market health presents a complex challenge for policymakers, as they navigate the delicate balance between fostering growth and controlling inflation. The implications of these insights are profound, urging us to closely monitor economic indicators as we assess the trajectory of monetary policy. The current landscape reveals a strong bullish sentiment across global equity markets, which is putting pressure on the safe haven dollar. This dynamic is providing a tailwind for the euro to US dollar pair, making it an interesting play for traders. However, there's a palpable sense of caution in the air. Many traders are holding back, waiting for clearer signals regarding the Fed's rate cut trajectory before committing to their next moves. This hesitation underscores the importance of upcoming economic indicators. All eyes will be on the U.S. Personal Consumption Expenditures Price Index set to release this Friday. This data could be pivotal, influencing not just the dollar's strength but also shaping the broader market sentiment. As we navigate these waters, staying informed and ready to react will be key for positioning ourselves effectively in this evolving Forex landscape. Today, traders should keep a close eye on the upcoming speech by Fed Governor Michelle Bowman. Her insights could provide critical cues for market movements. Additionally, we have the Conference Board's Consumer Confidence Index and the Richmond Manufacturing Index releasing today, both of which are key indicators of economic health. These figures can significantly influence trading strategies, so it's essential to stay informed. Also, Deutsche Bundesbank President Joachim Nagel is set to speak, and his comments might create short-term trading opportunities. With these events on the horizon, it's a pivotal day for traders looking to navigate the market effectively. Stay sharp and ready to react. The euro to US dollar landscape is shaping up with some compelling bullish themes. Eurozone inflation remains a persistent challenge, but the recent data shows that the region has almost eliminated its trade deficit as of May. This is a significant shift that could bolster the euro's strength. Looking ahead, the European Central Bank is signaling a slower pace of rate cuts compared to the Fed in 2024, which suggests that the ECB is committed to tackling inflation head-on. Their tough stance indicates that policy rates, currently at 3%, may not have peaked yet. As we analyze these factors, it becomes clear that continued growth in the Eurozone, coupled with further tightening from the ECB, supports a bullish outlook for the euro in the medium term. For Forex traders, this presents a unique opportunity to capitalize on potential upward movements in the euro to US dollar pair. The European Central Bank is poised to maintain its current trajectory for a while longer, with analysts suggesting we could see another 150 basis points of rate hikes, pushing us towards a terminal rate of 4%. This tightening of monetary policy is expected to bolster the euro, especially as we observe positive growth trends within the Eurozone. Declining inflation in the US, coupled with China's reopening and lower gas prices, is likely to stave off a significant economic slowdown. This environment creates a favorable backdrop for the euro, as the ongoing rate hikes signal a commitment to strengthening the currency. With an improving outlook for both the Eurozone economy and the euro itself, investors should remain vigilant. The interplay of these factors suggests that the euro may continue to gain traction, making it an intriguing prospect for those looking to navigate the current market landscape. The euro to US dollar is facing significant bearish themes that investors should closely monitor. European underperformance relative to the US is likely to weigh heavily on the euro. With the European Central Bank signaling an end to rate hikes and the Eurozone economy showing signs of stagnation, the outlook appears grim. Interest rate and economic growth differentials clearly favor the US, making the dollar more attractive. Moreover, Russia's decision to eliminate euros from its wealth fund adds further pressure on the currency. The European Commission's forecast of a decline in the Eurozone economy for Q4 2022 and Q1 2023 only compounds these concerns. And let's not overlook Italy's mounting debt, which poses a serious risk to the stability of the Eurozone. All these factors suggest that the euro could face a tough road ahead, making it crucial for traders to stay informed and agile. Inflation risks are looming larger than ever, while growth risks are increasingly concerning. The European Central Bank is shifting its focus from combating inflation to grappling with its implications. We find ourselves in a precarious situation. Europe is under immense stress as we brace for a challenging winter ahead. With underwhelming growth in the Eurozone, it's clear the ECB will lag behind the Fed in responding to these economic pressures. The fallout from the Russian-Ukrainian war has left Europe as the biggest loser, and the specter of recession is becoming more pronounced, particularly in Germany. As business leaders, we must navigate these turbulent waters with caution and foresight. The stakes have never been higher. The euro to US dollar pair is shaping up for a bullish trend as we anticipate a slowdown in the US economy. With the Fed facing a higher hurdle for rate hikes this month, we could see fresh declines in the US dollar. This weakness is likely to accelerate throughout 2024, especially as market focus shifts to potential Fed rate cuts. The central bank seems increasingly comfortable with receding inflation, which adds to the bearish sentiment for the dollar. Moreover, the US dollar's status as the primary global reserve currency is under pressure, and we're witnessing signs that America might be on the brink of losing its petrodollar privilege. For Forex traders, these dynamics present a compelling case for positioning in favor of the euro as we navigate these shifting tides. As we analyze the current landscape, it's evident that other regions may need to intensify their efforts against inflation, particularly by addressing the widening spreads in debt securities yields. The interplay of lower Fed rate expectations alongside an improved risk sentiment paints a rather bleak picture. This combination is quintessentially negative, suggesting that we may have reached a tipping point. With no further Fed hikes on the horizon, we could see a scenario that proves lethal for the US dollar. Moreover, the likelihood of the US economy slipping into recession looms large, prompting the Fed to potentially cut rates more aggressively than its global counterparts. This divergence could reshape capital flows and investment strategies, making it crucial for analysts to recalibrate their forecasts. The implications are profound, and the need for vigilance in our assessments has never been more critical. As we look at the euro to US dollar pair, bearish themes are becoming increasingly evident. The dynamics of monetary policy are likely to favor dollar strength as we head into the early part of next year. A softer growth outlook in Europe is driving safe haven flows towards the dollar, which is supported by several key factors. The US economy shows reasonably steady trends, and the Fed's hawkish stance reinforces this strength. Significant upgrades in economic forecasts suggest that US dollar gains will remain sustained. Additionally, markets are buzzing with companies leading the charge in AI services, which could further amplify pressures for currency appreciation. In this environment, it's crucial for Forex traders to stay alert and adapt to these shifting dynamics. The dollar's resilience could reshape trading strategies in the months ahead. The current slowdown in US inflation and growth is proving to be a lengthy process. As we navigate this economic landscape, it's clear that the Federal Reserve is likely to keep raising interest rates. This means that the US could see permanently higher rates compared to other countries. What's particularly intriguing is the potential for a re-acceleration of inflation. This could catch the market off guard, as the Fed's actions may not align with rising prices. So, while we might expect stability, the reality could be a persistent tug-of-war between inflation and the Fed's policies, keeping everyone on their toes. Understanding these dynamics is crucial for anyone looking to grasp the complexities of today's economy. As we dive into the euro to US dollar forecast for 2024, we see a landscape shaped by economic recovery and market sentiment. In the coming months, I anticipate the euro gaining ground, driven by potential improvements in the Eurozone economy. However, the critical threshold to watch is 1.0390. If we see a downturn, a collapse below this level could signal deeper issues ahead. Traders should keep an eye on key economic indicators and central bank policies, as these will heavily influence the pair's trajectory. The interplay between US interest rates and European growth will be pivotal. A steady recovery in the Eurozone could bolster the euro, but any signs of weakness may lead to volatility. Stay alert, the dynamics of this currency pair are ever evolving. As we analyze the euro to US dollar pair, it's crucial to note its fluctuations in 2023, trading between 1.0447 and 1.1275, driven largely by market sentiment. Looking ahead to 2024, the political landscape will play a pivotal role, particularly with the US presidential election on November 5. The nomination process kicks off in January and runs through June, setting the stage for potential volatility. Donald Trump's bid for the Republican nomination adds an intriguing layer of uncertainty. Traders should keep a close eye on how these political dynamics influence economic indicators and market sentiment. The interplay between political events and currency movements could create significant trading opportunities in the coming months. A potential second term for Donald Trump could significantly impact inflation, particularly through the reintroduction of tariffs on imports. This move would likely disrupt the delicate agreements established between China and the Biden administration, leading to increased costs for consumers and businesses alike. For Forex traders, this scenario raises critical questions about the euro to US dollar exchange rate. If inflation rises, the Federal Reserve may be forced to adjust interest rates, creating volatility in the markets. Investors should closely monitor the actions of the European Central Bank as well, as their response to US inflationary pressures could further influence the euro to US dollar pair. Understanding these dynamics is crucial for making informed trading decisions in an increasingly unpredictable environment. Keep an eye on the news, it could be a game changer for your portfolio. As a financial professional, understanding the role of the European Central Bank is crucial. The ECB is tasked with managing monetary policy for the Eurozone, with a primary focus on maintaining price stability. Its goal? To ensure that the year-on-year increase in consumer prices hovers just below 2% over the medium term. This target is vital for preserving the euro's purchasing power and preventing inflation from eroding it. Additionally, the ECB plays a significant role in controlling the money supply, influencing interest rates, and ultimately steering economic growth. The decision-making process involves several key bodies, including the Governing Council and the Executive Board, which work in tandem to navigate the complexities of the Eurozone economy. Understanding these mechanisms is essential for anyone involved in financial markets today. The Executive Board, the Governing Council, and the General Council play pivotal roles in shaping monetary policy within the European Central Bank, with Christine Lagarde at the helm as president. Her leadership is crucial in navigating the complexities of the Eurozone's economic landscape. In contrast, the Federal Reserve System, the central banking system of the United States, operates with a dual mandate to maximize employment and stabilize prices, targeting an inflation rate of around 2%. This balancing act is essential, as the Fed's decisions ripple through global markets, influencing everything from interest rates to consumer confidence. Understanding these institutions and their objectives is vital for financial professionals, as they directly impact investment strategies and economic forecasts. The interplay between these entities not only defines monetary policy in their respective regions but also shapes the broader economic narrative on a global scale. The Federal Reserve System is a fascinating structure that plays a crucial role in our economy. At its core, we have the Board of Governors, appointed by the President, overseeing the entire system. Then there's the Federal Open Market Committee, or FOMC, which meets 8 times a year. During these meetings, they dive deep into economic and financial conditions, making critical decisions about monetary policy. Their main goals? To maintain price stability and promote sustainable economic growth. They assess risks that could impact these long-term objectives, ensuring that the economy remains on a steady path. Understanding how this intricate system operates is essential for grasping the broader economic landscape. The decisions made by the FOMC can influence everything from interest rates to inflation, shaping the financial future for all of us. Christine Lagarde, born in 1956 in Paris, has had a remarkable journey in the world of finance. After graduating from Paris West University Nanterre La Défense, she made history as the first female president of the European Central Bank on November 1, 2019. Before that, she led the International Monetary Fund from 2011 to 2019, navigating through global economic challenges with a steady hand. Her extensive experience in various senior ministerial roles in the French government has equipped her with a unique perspective on economic policy and international finance. Lagarde's leadership style combines pragmatism with a vision for sustainable growth, making her a pivotal figure in shaping Europe's economic landscape. Her influence continues to resonate as she tackles the complexities of monetary policy in an ever-evolving global economy. During her tenure from 2007 to 2011, she held pivotal roles in shaping economic policy as the Minister of the Economy, Finance, and Industry. In 2007, she briefly served as Minister of Agriculture and Fishing, where she tackled issues like sustainable farming and food security. Prior to that, from 2005 to 2007, she was the Minister of Commerce, focusing on trade policies that aimed to enhance competitiveness in a global market. Switching gears to Jerome Powell, he became the chairman of the Federal Reserve in February 2018. His leadership has been crucial in navigating economic challenges, particularly during the COVID-19 pandemic. Powell's term as a member of the Board of Governors will last until January 31, 2028, allowing him to influence monetary policy and interest rates during a critical period for the U.S. economy. Both figures exemplify the dynamic nature of economic leadership and the impact of policy decisions on national and global scales. Born in Washington, D.C., I pursued my passion for politics at Princeton University, where I earned my bachelor's degree in 1975. This foundation led me to Georgetown University, where I completed my law degree in 1979. My career took off in the public sector when I served as Assistant Secretary and later as Undersecretary of the Treasury under President George H.W. Bush. This experience deepened my understanding of economic policy and governance. Transitioning to the private sector, I worked as a lawyer and investment banker in New York City, honing my skills in finance. From 1997 to 2005, I was a partner at the Carlyle Group, where I navigated complex investment strategies. Each of these roles has shaped my perspective on the intersection of law, finance, and politics, illustrating the dynamic nature of public service and private enterprise. The euro to US dollar currency pair is a powerhouse in the Forex market, representing the two largest economies in the world, the Eurozone and the United States. As a major pair, it's not just popular, it's essential for traders and investors alike. The euro serves as the base currency, while the US dollar acts as the counter currency. This dynamic creates a fascinating interplay, influenced by economic indicators, geopolitical events, and market sentiment. Traders often analyze factors like interest rates, inflation, and employment data to predict movements in this pair. The liquidity and volatility of euro to US dollar make it an attractive option for both day traders and long-term investors. Understanding this pair is crucial for anyone looking to navigate the complexities of the Forex market effectively. The euro to US dollar pair dominates the Forex market, accounting for over half of all trading volume. This sheer volume makes it highly unlikely for gaps to form, especially breakaway gaps in the opposite direction. During the Asian session, trading activity tends to be subdued. This quiet period is largely due to the timing of economic data releases, which typically occur during the European or US sessions. As a Forex trader, understanding this dynamic is crucial. It highlights the importance of timing your trades and being aware of market sentiment. The lack of volatility in Asia means that significant price movements are often reserved for when the European and US markets are active, creating opportunities for informed traders to capitalize on. As the European trading day kicks off, it's like a race at the starting line. Traders dive into their desks, and suddenly, the market buzzes with activity. Orders flood in, and everyone's jockeying for the best positions. But come noon, it's like someone hit the pause button. Traders step out for lunch, and the energy dips. Then, as the US market opens, it's game on again. If there's crucial economic data on the horizon, you can feel the tension in the air. Markets often go quiet, holding their breath before the numbers drop. Depending on whether the US data beats or misses expectations, we could see a trend solidify or flip on its head, especially with the euro to US dollar pair. It's a thrilling dance of anticipation and reaction, and as traders, we're right in the thick of it. As we approach 5 o'clock Greenwich Mean Time, it's crucial to note how liquidity begins to dwindle in the Forex market. European traders are wrapping up their positions, which can lead to increased volatility and wider spreads in pairs like pound sterling to US dollar. This currency pair, part of the majors, is particularly sensitive to these shifts. When liquidity leaves, the market can react unpredictably, making it essential for traders to be vigilant. The pound sterling to US dollar isn't just another pair, it's a barometer for global economic sentiment. As the European session closes, keep an eye on how this affects your trades. Remember, understanding these dynamics can give you an edge in your trading strategy. The pound sterling to US dollar currency pair, often referred to as the cable, has a fascinating history rooted in the mid-19th century. This term originates from the first transatlantic cable, which connected Great Britain and the United States, revolutionizing communication across the ocean. As one of the oldest currency pairs in the world, it symbolizes the economic strength of both nations. The British pound and the US dollar represent two of the largest economies globally, making this pair a focal point for traders and investors alike. Its popularity stems not just from historical significance, but also from the dynamic interplay of these powerful currencies, reflecting economic trends, political events, and market sentiment. Understanding the cable is essential for anyone looking to navigate the complexities of global finance. The cable, or pound sterling to US dollar, has been a focal point for Forex traders, especially post-Brexit. The volatility we've seen since the referendum reflects the market's reaction to the uncertainties surrounding the UK's exit from the EU. With the pound as the base currency, fluctuations are often driven by economic data releases and geopolitical developments. Traders need to stay alert. Any hint of a trade deal or economic stability can lead to sharp movements. Switching gears to US dollar to Japanese yen, this pair remains a heavyweight in the Forex arena. The interplay between the US dollar and the Japanese yen is influenced by interest rates, economic indicators, and risk sentiment. When the market is risk-averse, the yen often strengthens as a safe haven. Understanding these dynamics is crucial for making informed trading decisions. Both pairs offer unique opportunities, but they require a keen eye on global events and economic trends. The Japanese yen, with its persistently low interest rates, plays a pivotal role in the world of carry trades, making it one of the most traded currencies globally. In the US dollar to Japanese yen pair, the US dollar serves as the base currency, while the yen acts as the counter currency, effectively representing the economic dynamics between the United States and Japan. This relationship is crucial for investors, as fluctuations in this pair can signal broader market trends. Interestingly, trading US dollar to Japanese yen is often referred to as trading the ninja, a nod to its stealthy movements. Meanwhile, the pound sterling to Japanese yen is more commonly known as the gopher, highlighting the unique characteristics of these currency pairs. Understanding these nuances is essential for investment professionals looking to navigate the complexities of the Forex market effectively. The US dollar-Japanese yen pair often exhibits a positive correlation with US dollar to Swiss franc and US dollar to Canadian dollar. This relationship stems from the fact that all three pairs share the US dollar as their base currency. When we analyze the dynamics, it becomes clear that fluctuations in US dollar to Japanese yen can be significantly influenced by interest rate differentials between the Federal Reserve and the Bank of Japan. For instance, when the Fed raises rates, it typically strengthens the USD against the JPY, as traders seek higher yields. Conversely, if the BOJ maintains its ultra-loose monetary policy, the yen weakens further. This interplay creates a ripple effect across the correlated pairs, making it crucial for Forex traders to monitor central bank announcements closely. Understanding these correlations can provide valuable insights for making informed trading decisions in the ever-evolving currency market.
Thanks for tuning in to Global News 04, your source for all the latest news across every area. Don't forget to like, share, and subscribe to our YouTube channel. Stay tuned, and make sure to turn on all notifications to stay up to date with the latest global news. Check out our other videos for more in-depth coverage, and follow us on social media to never miss a beat. If you'd like to support our work, scan the QR code to make a contribution. See you next time.